Hi everyone, welcome back to the channel. This is Rob with Velocity Portfolio. In this video, I wanted to do a hopefully somewhat quick mental framework for market drops. I've had a lot of people request this type of video. What my plan is, what my thought process is, what my framework is, what I intend to do if we have large market drops. And I've been planning this video, and it just so happened that we had a pretty decent drop in the market today. So the timing, I think, couldn't be better. So I'm going to go over kind of my framework, what I have in my head, my thought process, everything that I'm thinking about, and some worst case scenarios if we get some really large drops. Before I jump into that, I'll just show the portfolio real quick, how we're sitting as of today after the big drop. And then, of course, I want to cover what we're doing with this portfolio. So before anything, with market drops, because I'm living out of this portfolio, as this image displays, you have to think about drops differently, right? With an account that is just, DCA, dollar cost averaging long term, like a retirement account, with your company or your employer, you don't really have to think about it, or you shouldn't be thinking about it. You should just be contributing money, letting it compound over the years, and letting it do its thing. But when you're managing equity and margin, because you're using that to pay your bills, you really have to think about market drops differently, and you have to be prepared to make some moves if need be, more than just buying. So a reminder, all of the income that me and my wife earn goes into this Velocity portfolio, which is a regular brokerage account. It's not a checking account. So no money goes into the checking account. No money sits in my checking account. I don't have a savings account any longer. All money earned and that I have is in this portfolio, in this account at the moment, except for retirement accounts, of course, and things like that. And when I receive this money, I invest anything I deposit right now into these three categories at these percentages. This is the allocations I'm shooting for. All of my expenses each month, whether it be a credit card bill, my mortgage, gas, going out with some friends to grab drinks, whatever it might be, is all paid for with this account on margin. So it's borrowed on margin. And then any dividends I receive throughout the month pay down that margin balance. So real quick, I want to jump into just a quick update. Right now, after the drop, my last video was on Friday night, so a few days ago, and it was approaching 150. It was like almost 149. So a decent drop today. My total profit has dropped quite a bit as well, and internal rate of return, everything is kind of dipped, except the income percentage. Obviously, as asset prices drop, the income looks larger from dividends, so that percentage went up a little bit. So you can see the giving fund is down just a tad bit, 1.27. The super high yield funds took a hit today, of course, but I'm still up overall on all these. So the market tried to climb back and then sold off pretty heavily, which is pretty common. So not to dive too deep in there, but I wanted to just show quickly where we were sitting. And now let's jump into the actual meat and potatoes of the video, right? So I started up a newsletter in relation to this channel, and I post on there weekly, just kind of how the week went, my mindset, my thought process. And this is something that I put out in my newsletter and sent out to my subscribers this past weekend. And it may not make sense to you, but it kind of sums up how I'm managing this account over the next 5 to 10 years. So just another week of the portfolio chugging along. I think of this strategy or journey like a trip across the sea in a boat. You depart from one coast and headed for another coast on the other side of the world. Initially, it seems like such a long time and so far away, but you take it a day at a time, and mostly because you have to. Things are thrown at you every day that could set you off course. In this case, life. There are minor and more severe storms along the way. In this case, the stock market. And sometimes little control over the velocity of the winds you will receive in your favor. Income and expenses. So how much income you're receiving, job loss, things like that. And then expenses that pop up, an appliance goes down or car breaks down, something like that. You're trying to get through each day without taking on too much water and capsizing before you reach the destination. FIRE. So the destination is FIRE, financial independence, retire early. This is at least how I play it out in my head from time to time as I think through my journey. So anytime there's market drops and things like this, I just think of it as this trip across the sea, and we're going through a storm, and we're just trying to get through it and come out the other side as unscathed as possible. It's more of a trip of kind of survival just to get to that end, because I know that in a shorter period of time, it's going to work out, rather than the 30 and 40 traditional retirement. So just wanted to start with that. Now, going into actual market drops, I pulled this off of, yes, AI, just to give me kind of an idea and a framework for what we're looking at in terms of drops. And there are a lot of people that don't know this as well. So what is a drop, right? What do we consider a drop? So from 0 to 20% is termed a correction. And the frequency since the stock market was started, or in its inception, has been every 1 to 2 years. There's usually a 0 to 20% drop in the market. Typical recovery time is 4 months. Bear market is described as 20 to 30% drop. And this happens every 6 to 7 years. Recovery time 1 to 2 years. 30 to 50% is a severe bear market. This happens every 15 to 20 years. Recovery time 3 to 5 years. And then 50 plus. Very, very rare. It does happen. Likely wouldn't happen unless we had some World War III or something like that. But it's only happened twice in the last century. So the Great Depression, and there was one other occasion as well. So recovery time 10 plus years. So obviously if this happens, it's a big deal, but very much less likelihood, right? So I just wanted to kind of go over those real quick. I don't really worry about the 50 plus. To be honest, if we have a 50 plus or 50% plus drop, I think we have bigger problems than our portfolios. We're talking economy crash, world economy crash, bank crash, real estate crash, like everything. And probably everybody's going to lose their jobs. A lot of people are going to lose their jobs. And, the portfolio is going to be a second thought. I'm not really preparing for that because I don't know if there's really anything I can do to prepare for that. You just have to take it a day at a time at that point. So in this video, I really want to talk about the 0 to not even 50%, but the 0 to like 30% drops. I know 40% or 30 plus can happen. They're just not as common. Even the 30 to 50 is not as common every 15 to 20 years, right? If you think of this portfolio, I'm shooting for the next 5 to 10 years. So technically, if you're looking at a frequency at an average, I won't even hit this time frame. But of course, I want to be as prepared for it as possible. And I want to be clear on this. I am not recommending that anybody do it this way. This is just how I think about it. I'm not a financial advisor. I'm not seeking perfection. I'm not looking for the perfect hedge or anything like that against a market drop. I'm not expecting that. A big part of my strategy is just having things in place so I don't make emotional decisions, make the correct decisions if and when it does happen. I'm not trying to predict the market. I'm just trying to be as prepared as possible, but again, not trying to be perfect. And a lot of it is going to be a day at a time. Like today we saw at one point a 2+ % drop in the market. Tomorrow we could see another 2-3%. We could see another. So by the end of the week, we could possibly drop 10%, right? So it can happen very quickly, in this time frame a week, but the chances of it happening in like 1 or 2 days are slim, right? So it really is taking it a day at a time. Like today, my antenna went up, spidey senses went up, like, okay, big drop. Okay, let's start preparing, right? I didn't do anything today because I just didn't think it's as big of a drop yet. Tomorrow, if we have the same kind of drop, now I might start trying to implement some things, and so on and so forth. And of course, if we have like a COVID situation where everything just drops so fast, again, I'll have to make decisions, but that's why I am going to go over this and kind of my thought process. So jumping into it, I just tried to make some bullet points to make sure I try and cover everything here. So market drop plan, real creative, right? So first bullet point here is margin equity management. So I mentioned in the beginning, I have to manage equity. When you're living out of your portfolio, you're not so much worried about the numbers if it doesn't relate to your equity percentage, because that's what we're managing. Right now, I'm sitting at about 80% equity. A margin call happens at about 30%. So roughly 50% drop in my portfolio would trigger a margin call. I'm going to speak to this as if my portfolio was sitting at 60%, which is the lowest I ever want to get. That way it gives me roughly a 30% buffer. If the market drops 30%, then I've got like a 30% buffer before I'm up against a margin call. So assuming I'm at 60, so like today, a couple times throughout the day, I went and checked to see what my equity percentage was. Didn't really drop all that much. If we get another big drop tomorrow, I'll do the same thing. I'll do the same thing. I'll do the same thing until the end of the week. Let's assume it drops every day this week, right? And it drops like 10%. I'm going to see what my equity percentage is, and I'm going to make decisions off of that first. It's going to be, okay, did my equity percentage drop from 60 to 50? Okay, that's like a third of what I'm trying to have available, and in a quick time frame, in a week, right? So maybe I need to start making some changes. So that's how I think about managing the portfolio. And then with that, I'm still going, assuming nobody loses jobs. If me or my wife or anybody out there loses their job, we're talking about something totally different, right? I understand that we have recessions and people lose jobs and all of that, and nobody's immune to it. So obviously this whole plan gets blown up a little bit if people lose jobs and you lose your income. That's a whole different animal. But we're assuming nobody's losing jobs. I'm not losing jobs or anything like that. So the plan would be to continue investing income. The plan would be to do exactly what I've been doing, is just continue investing my paychecks and continue buying assets and continuing dollar cost averaging on what I feel is a good value that I currently hold, or one that I've been eyeing, a potential ticker or asset, right? So that's the plan initially. So if I was getting paid tomorrow, yes, we had a big drop today, I'm still going to buy as if I do every week. So that's kind of the short answer, is I'm going to keep doing exactly what I'm doing until the market drops more and more. If that happens, I'm going to slow down on select purchases. So if we see like a 5, 10, 15% drop in a week or two or a couple weeks, then I might start looking at like super high yield funds and high yield funds and not investing in those as much anymore, and looking for more stable assets, stable ETFs or stable stocks. Like I posted my portfolio today in my Discord, and my only stocks that were up today were Procter and Gamble, Costco, Pepsi. So those types of stocks, all the tech, all the Bitcoin, all the high yield funds, things like that were all down, every single one of them. So I only had like 3 or 4 holdings that were up, and it was those types of companies. So I would probably purchase more of those, or I might see a good opportunity to dollar cost average. It really depends on the crash, right? What caused it? Is there an actual change in the market, or is this just fear? There's a lot of things that go into it, and I think and look at these things. I read the news. Most of it is noise, and I've become immune to a lot of it. Now I've been investing for long enough that I've really become immune to it, and I've gotten quite a bit better at deciphering if it's real or serious or not. That being said, the old saying is the market can be irrational longer than you can stay solvent. Totally aware of that as well. So like I said, at the end of the day, it just kind of comes down to a day at a time. Today I had thoughts. Tomorrow I'll wake up with different thoughts depending on how the market's doing, the news that's out. Trump is talking about invading Greenland. So, that's swaying the market. There's tariffs, more tariffs potentially coming. Companies are reporting that, the tariffs that have already been implemented are really starting to take effect. So to me, that's still all just noise. Until things actually happen, that's when things really could, quote, hit the fan. And that's when I'll start making more drastic decisions. So if those types of things happen, what I plan to do is keep investing my income, because I want to keep growing the account, except I might slow down on the purchases altogether. So if we get a more serious drop than slowing down on select purchases, I might slow down altogether, and I might just let dividends coming in and my paychecks pay down the margin balance, either altogether or, as much as possible. I might still want to throw a little bit into some funds and dollar cost average down and things like that, as long as my, back to equity management, as long as my equity percentage is okay. If I'm getting pushed into like that 30% range, and really, if it's really bad and I'm getting up close to a margin call potentially, that's when I'm going to let dividends and my deposits from income pay down the margin balance, at least short term, until I start to see what I think is a bounce back, and then maybe start buying so that I can actually buy at the low, right? It's not about timing it perfectly. It's about just trying to get a better price than you had before. That's all I'm really concerned about. I have tried to time the bottom and time the top, and I'm not good at it. And it's very stressful if you don't know what you're doing, and most people can't. So And again, I'll be real selective with my asset sales if things really, really get bad. So the opposite of slowing down on select purchases, if it really got bad and I got up to a margin call, I would find things that have a higher margin percentage, equity percentage. Like for instance, HOOW right now, I think with Schwab is 100% equity. And so is XPay, which I just added recently. So if that happens, then I could unload those higher equity positions or higher percentage positions, and that'll free up some equity for me. I can, sell it all, sell some, or if I'm still happen to be up on some other holdings, I could sell those for a gain. That will be kind of part of the worst case scenario, is possibly sell assets. I never want to sell unless I'm rebalancing or something like that. And even then I would just buy other assets to rebalance. But I really only want to sell if I don't believe in that fund or that stock anymore. But in a worst case scenario, before I did anything else, that's probably the first thing I would do, is start selling some holdings that have higher percentages. Cash injections if needed. So in addition to my obvious weekly paychecks and any other income going in, if I had to come up with some other cash to inject into the portfolio to keep, a margin call from happening, then that's what I would do. And I'll go into more of that in a second here. I also have protective puts on, so I have hedges. So I always keep roughly 30 data expiration hedges, puts. I buy puts in the portfolio on QQQ and SPY, and I try to keep them on at all times. I have 2 of each on right now. They went up quite a bit today, and if there was steep drops, they would go up quite a bit. These are not, I'm not intending these to be a 1-for-1. I'm not expecting these to gain as much value as my market would drop. It's just meant to slow it down a little bit. So where if, market drops, portfolio drops to the same as the market or worse, I'm hoping those puts will just keep the equity percentage of my portfolio a little bit higher and buy me a little bit time. And also they could be used, because they're going to go up in value, they could also be used as, quote, dry powder to purchase more assets if I feel like the bounce is coming. So a couple of different things there. I don't expect to make money on these. I don't really ever expect to make money on them. I just consider it an expense. I buy them. I try to aim between $300 and $400 at the most right now until my portfolio gets bigger, and then I'll shoot higher and maybe more of them. But for now, they're just meant to hedge the portfolio a little bit and give me a little bit more time and give the market a little bit more time to recover. Liquidity planning. Again, this just kind of goes back to if I need to pull money from somewhere to inject into the portfolio. It's pretty much the same as cash injections here. I shouldn't have even included that. And then psychological discipline. This is one that really takes time. I haven't been investing that long. I'm 38 years old. I've probably been seriously investing for almost 10 years now. So yes, I haven't been through the '08. I mean, I went through it. I had, money in the market, but I wasn't doing nearly what I'm doing today. I didn't understand most of it. I was around in 2000, but I was a teenager. Didn't really understand the severity of that. I was investing during COVID, and surprisingly, I didn't panic in that situation. So building that psychological discipline is very, very important, and arguably the most important when it comes to market drops, because when you start seeing a lot of red and you're not used to it, you can make emotional decisions. And I have done it. I have done it in the past where I've taken thousands of dollars in losses because I had a psychological meltdown because the market was crashing. I've tried day trading. I've done very well in day trading. And then I've also lost a lot of money in day trading because of my emotions and not having psychological discipline. I can't tell you how many times I sold out of a position and then 30 minutes later it bounces back up or goes back down if I was shorting it. And I could have made more money, but because I couldn't emotionally hold up, I lost a bunch of money on it and got out of the position. So psychological discipline is really important, because when the market drops, sometimes the worst thing you can do is sell. So that's why I have kind of these rules in place. I will only sell if I come up against a margin call and I don't see, money coming in from income, or the market just continues to drop. And I'll document it here. I don't want to make any emotional decisions and really, really make things worse than they already are, right? So that's very, very important to me. And the bigger the drops is different behaviors, right? So I actually kind of have the opposite psychological thought now when the market drops. So like today, I checked my portfolio and it was down like 2.5%. And my first thought was like, oh, I need to buy some stuff, right? Even though I don't have income coming until Friday, I wanted to maybe advance my income coming in and buy some stuff. But I held myself back. I was excited, but I held myself back because even though my portfolio as a whole was down 2.5%, there wasn't really a lot of buying opportunities in my portfolio. I was still up on a lot of my positions overall. And my goal is to buy them lower if I can. And I don't know what the market's going to do tomorrow. It might pop right back up. We might have a short V-shaped recovery, whatever. Or it might continue to drop. But I didn't want to just kind of blow everything on the first drop, right? So it's probably when it gets to like 7, 8, 9, 10% drop is when I really want to start deploying more cash and getting ready for any kind of bounce. Because if you go back to here, it happens once every 2 years. And the recovery time is short, most importantly, right? So if you buy, probably in 4 to 5 months, you're going to end up making money on that position. So that's kind of my thought process behind that. And then I just alluded to this, but through any of this, I intend to report it here. So if the market drops 30%, 20% by next week or by next month, I'm going to do videos on it. I fully intend to keep this video going until I hit my goal and probably beyond. So I'm not planning on going anywhere. I'm not going to close up shop. I'm not going to just stop doing videos. Just doing videos on the good is only half of it. If I really started this channel to teach my daughter and future kids and my wife and friends and family, I need to be able to show things like this. And if the market does drop a lot, I need to be able to show how I handled it for better or worse, so that they can learn the good and the bad, and all you guys can learn the good and the bad from me. And I'm just the average person. I don't know as much as a lot of people out there. So in a way, it's kind of, I think, a way for the average person to learn from another average person, right? Because you have all the talking heads on TV that are saying to do this, do that, and most of the time they're wrong anyways. And I don't claim to be right or wrong or know anything about what I'm doing here. I'm just trying to give you my mindset around this so that you can learn from it. My future kids can learn, my kid and my future kids can learn from it, my wife, friends, family, and all that. And then myself, of course, I can reference back to these. If we get a big drop in the next coming weeks, then I can reference this a couple of years from now or a few years from now if we get another big drop and think to myself, what did I do in that situation? So either way, I will be reporting it here. I will be reporting it in the Discord. I will be available. I'll be writing newsletters about it each week so that you guys can follow along. So worst case scenarios, I guess these kind of go hand in hand. Worst case scenarios and backup funding options. So we're talking absolute worst case scenario. Market continues to drop, nothing but red. We're looking at like COVID level drops, but sustained longer. Maybe a 2008 drop, right? 40, 50% market just continues to drop. I'm living out of this portfolio. A few things that I would do. So I've already tried to sell selective assets, right? I've already sold off the high margin maintenance ones. Those are gone. Portfolio keeps dropping. I'm now back up against a margin call, just getting crushed, right? Worst case scenario. I would have some backup funding options, and those backup funding options would be things like a HELOC loan against my house. If it's an option, right? If the value of my house drops a lot, I may not be able to do that, but if it's an option, a 401k withdrawal or borrow against it. So my wife and I's. I also have a couple of IRA accounts that have a little bit of money in them that I could pull from if I need to. Of course, I'd pay tax and penalties to do so, but pulling them and putting them into the market at the lows that they're at, I think is going to yield a lot more than leaving them in that account. So yes, I would take a loss on those accounts dropping as well, but taking that money and investing them into this portfolio at the lows that we would be at, I think would pay huge rewards in 5 to 10 years. So those would be backup funding options. I could also, I would also tighten my lifestyle. So, we live pretty free right now. We could cut our expenses more every month, but with how I grew up and just being dirt poor growing up, I like to live life a little bit. And I'm not talking like crazy, like we go out to eat every night. We actually don't eat out really at all. We cook at home 99% of the time. But, when we go to the grocery store, we don't look at prices. We shop at Trader Joe's and Costco for the most part. So it's already pretty inexpensive, but I don't worry about prices too often. I can't remember the last time I counted the amount that I roughly had in my cart. And I like that. That's something that I was never able to do as a kid. It was always every time I wanted something, whether it be, a box of crackers or a box of cereal that was at the time $1.99, my mom would first say, "How much is that?" And I'd tell her, and she's like, "No, you're not getting it. We can't afford that," or whatever. So I don't want to live like that. But if this situation happened, I would, temporarily and short term, I would cut subscription services that I don't need. We would cut, driving as much if we had to. We would cut grocery shopping. We would start kind of looking at the prices a little bit more, and I'm totally okay with that for the short term. But do whatever we have to survive this quote storm that we're going through, like I said in the beginning, right? So I have some options there. And then another worst case scenario, again, assuming nobody's losing their job or has lost their job, right? Another situation would be I just stop contributing to the portfolio. And that would be probably the last thing I would do. I would probably pull money from other things before I did that. I would probably pull money from my retirement accounts, borrow money on a HELOC, borrow money from my 401k or my wife's before I did that. But like the last line of defense would be I just stopped contributing to the portfolio. I would let dividends that are coming in, even though they've dropped because of the market drop, I'm getting less. I would let them pay down the margin balance. And this is assuming that I'm not up against a margin call any longer. This is making the assumption that I'm kind of right there on the cusp, but it's holding steady. I've got it managed, and I'm not up against a margin call. I would just stop depositing my income into this portfolio temporarily until things stabilized and started rising again. So I would no longer pay my bills out of this account. I would now take all of my income and just pay my bills directly, right? So all my bills and everything would be covered. I wouldn't have to stress on that. Then I would just have to manage this account. And if I had to sell more assets to keep it away from a margin call, if I had to pull money in to keep it away from a margin call, then I will do so. And then when the market starts to bounce back up and my equity percentage is now up, not up against it as bad, maybe it's 35, 37, 39, it's starting to creep up near 40, something like that, then I'll start investing my income again. And then I'm buying at the lower prices. It's just about survival at that point. It's about not selling out of everything, taking the huge losses, as little as possible at least, and being there for the recovery, because that's really where the money is made. And that's a fact. You can see all kinds of people online, and billionaires and millionaires talk about all the time, is being able to stay in the market and buy at those lows when we have big drops. That's where a lot of people make a lot of money. A lot of people made a lot of money during COVID when things dropped. People were investing in the stock market, me included, not as much as I wanted. People that bought houses and invested in the stock market in '08, they are retiring right now. I've seen stories of people that, were in their early 20s and they're now retired in their 30s because they put so much money into the market in like '08 and 2010. It's incredible. And I wish that I was able to take advantage of those. And if you stay invested, I can almost guarantee you that it's going to work out in the long run, 10, 15, 20 years down the road, that you're going to make money from that drop if you're able to sustain it. Again, not financial advice, not telling anybody what to do. This is all just how I think about all of this. And honestly, this helps me sleep at night. I don't wake up in the middle of the night worried about my account or anything like that. I'm not going to lose sleep tonight over the drop today. If it dropped 10% by the end of the week, I'm not going to lose sleep. I might lose sleep because I'm going to be trying to figure out what I want to do, what I want to purchase and things like that, but not that I'm worried about liquidation or margin calls or anything like that. I have become pretty numb and immune to that type of stuff by now, almost to a fault sometimes. Back when the tariff drop happened in April, I almost didn't even know what was going on. I was not really paying attention to where my portfolio was at. I was just like a robot, just buying. And I kind of knew because I was looking for things to buy at good prices, obviously, but I wasn't looking at the day to day. I couldn't even tell you on a given day how much my portfolio was down. I've been paying attention to it more lately, but just because I've been trying to communicate it more in the channel and things like that. But before I started this channel, I didn't really look at how much my account dropped on a given day. I have never looked at my 401k and how much it's dropped in a day. So I've become kind of like a robot in that regard, and I don't think that's a bad thing necessarily, because it makes you a little bit more immune to the noise and things like that. And last but not least, you have to have long-term conviction in the stock market. I've seen people out there that are just total doomers, and they'll jump into people's channels and they'll jump into social media, and then they'll just scare people and say, you need to sell out of everything because we're at the top. There's a drop coming, and they'll try to predict the markets. And there's so few people that can do that. It's really, really difficult. But when you've got people that don't know what they're doing necessarily, or they're just getting started on their investing journey, they listen to that and they almost become like prey for these people. And they could be right, of course, but the chances are they're usually not. So you have to have a long-term conviction in a stock market. You have to look at these numbers here, and you have to look at, the market goes up roughly about 75% of the time. And you have to look at the statistics and zoom out from, stock market inception and look at S&P returns over the last 20 years. And you really have to have that long-term conviction, especially if you're living out of your portfolio. If I didn't believe that the market always rose over the long term, why would I be doing this? I would just be throwing money into the fire, right? And there's all kinds of people doing this. And even the super, super rich use the stock market to get wealthy. So you really have to have that long-term conviction. And that's kind of what keeps you going on everything. Everything else is just managing. If you're living out of your portfolio, it's really just managing the equity percentage and making decisions based on the day and where you're at that given time and what is going on in the market and all of that combined, right? So again, going back to kind of my analogy here, life it just happens, and there's storms along the way in the stock market. There's news, there's drops, there's things like that. The wind that you have at your back, whether it be a job loss or expenses that you have coming in, those are going to happen. You just have to navigate them accordingly until you reach that other island, which is your FIRE, your financial dependence, retire early, or whatever your long-term goal is for your portfolio. So anyways, I don't want to ramble on any more than that, but I hope I covered everything and gave a decent idea. I'm not good at articulating this stuff, but gave a decent idea of my thought process on drops and this portfolio. If there's something you think I missed or have any questions, please drop it in the comments, and I'll answer it. You can jump in the Discord and ask it there as well. Thank you guys for listening and watching, and I will see you guys for the next update this coming weekend. Thank you.